Welcome to LegisShift AI. Today, we are pulling back the curtain on the three interconnected systems that keep organizations financially healthy and operationally strong. Today, we are breaking down the traditional barriers separating three critical financial functions: accounting, corporate finance, and treasury. While they all live under the office of the chief financial officer, confusing their responsibilities is a critical mistake that kills business efficiency. If the enterprise were a living organism, accounting would preserve its memory, corporate finance would chart its future, and Treasury would keep its lifeblood flowing. Let's start with accounting. This function provides the foundation of financial truth, ensuring every transaction is accurately recorded, classified, and reported. Accounting operates primarily in the past tense, ensuring that historical transactions are captured, validated, and transformed into reliable financial information. Its primary responsibility is accuracy and compliance, where every figure must be supported, verifiable, and fully documented. The accounting team oversees critical daily transaction activities, including accounts payable, accounts receivable, and general ledger management. They maintain financial accuracy and integrity, ensuring compliance with established reporting frameworks such as GAAP and IFRS. At the end of each reporting cycle, they generate the organization's definitive financial records, the core financial statements relied upon by external stakeholders. After every reporting cycle, this team converts a year's worth of financial activity into the statements that investors, regulators, lenders, and auditors depend upon. Under the leadership of the financial controller, this function safeguards financial accuracy, compliance, and protection against reporting errors and fraudulent activity. Now, let's shift our focus to corporate finance, specifically the forward-looking discipline of financial planning and analysis, commonly known as FP&A. If accounting looks at the rearview mirror, FP&A looks firmly out the front windshield. Their orientation is entirely forward-looking. Acting as the organization's internal advisory team, FP&A translates financial performance data into strategic recommendations that guide business decisions. FP&A develops the annual budget framework by partnering closely with business leaders to align financial resources with operational objectives. Through rolling forecasts, FP&A continuously recalibrates financial expectations by incorporating changes in market demand, pricing strategies, and cost drivers. Their ultimate goal is value maximization and strategic capital allocation by determining where to invest to achieve the highest return on investment. FP&A evaluates unit economics and product profitability, providing leadership with data-driven guidance on growth, investment, and operational adjustments. This brings us to corporate treasury. If accounting is the scorekeeper and finance is the architect, then treasury is the fuel manager. Treasury serves as the enterprise's liquidity command center, overseeing cash optimization, capital deployment, and financial risk management on a global scale. An organization may appear highly profitable in its forecasts and financial models, yet still facing solvency if Treasury fails to manage liquidity effectively. Treasury actively manages daily cash positions by optimizing banking structures and deploying capital to meet operational and strategic needs. While FP&A focuses on broader financial projections, Treasury develops highly granular cash forecasts, including the essential 13-week cash flow forecast. Treasury serves as the primary financial risk manager of an enterprise, actively mitigating foreign exchange fluctuations and interest rate risk. Treasury manages the company's capital structure, issuing debt, securing lines of credit, and cultivating deep relationships with global commercial banks. When surplus cash is resting in accounts, Treasury invested in safe, liquid, short-term money market instruments to optimize yield. Now, let's bring these three functions together and examine how their responsibilities differ across operational scope, time horizon, and strategic focus. From a timeline perspective, accounting is entirely retrospective, providing an accurate record of what occurred during prior reporting periods. While accounting explains what happened yesterday, FP&A concentrates on what the organization can achieve tomorrow, next year, and beyond. Treasury focuses on the immediate present and near-term future, managing liquidity across days, weeks, and quarters to ensure operational continuity. Precision is the foundation of accounting. Every transaction, journal entry, and account balance must be accurate, documented, and reconciled to the penny. FP&A relies on informed estimates and scenario-based assumptions, understanding that market conditions, customer demand, and economic factors are constantly evolving. Treasury requires exact transactional accuracy for banking execution, but relies on predictive modeling for cash position forecasting. Accounting is primarily driven by regulatory compliance, financial reporting requirements, tax obligations, and adherence to audit standards. FP&A is driven by strategic planning, sustainable growth, operational performance, and the creation of long-term shareholder value. Treasury is driven by asset preservation, continuous liquidity management, and strict financial market risk mitigation. The greatest organizational value emerges when accounting, FP&A, and treasury operate as a unified financial ecosystem rather than isolated departments. Every reliable forecast starts with reliable history. Accounting provides the verified financial records that allow FP&A to model future outcomes with confidence. FP&A transforms verified accounting data into enterprise-wide budgets and forecasts, which Treasury uses to anticipate funding requirements and capital deployment needs. Treasury continuously monitors real-time cash movements, providing actual liquidity data back to accounting to support reconciliations and variance analysis. Working capital optimization represents a critical point of collaboration, requiring accounting, FP&A, and Treasury to work in lockstep to manage the cash conversion cycle. Accounting tracks invoice processing speeds, Treasury optimizes bank floats, while FP&A analyzes how this cycle impacts overall returns. Take derivative risk management and hedge accounting. When Treasury executes a currency option trade to protect foreign sales revenue, they must instantly collaborate with accounting to ensure it qualifies under strict IFRS 9 or ASC 815 rules. Without this structural cohesion, Treasury's risk hedges create massive, unwanted volatility directly on accounting's profit and loss statement. No enterprise can achieve sustainable success by optimizing only one or two of these disciplines. Resilience requires alignment across all three. Accounting secures your historical truth, FP&A maps out your strategic path, and Treasury safeguards your immediate liquidity. For anyone aspiring to become a strategic chief financial officer, mastering the distinct boundaries and synergies of this triad is mandatory. If you want to continue optimizing your company's financial architecture, hit that subscribe button for LedgerShift AI. Thank you for watching.